Hello, I'm Andy Agathangelo, and I'm very proud to be the founder of Campaign Group Transparency Task Force. Transparency Task Force is a certified social enterprise that's been around since 2015. We started as a consequence of some conversations between friends, particularly Dr. Con Keating, who's with us tonight, and Dr. Chris Sear, who's not here with us tonight on this meeting, but we've also just been told by Con Keating has actually passed away this morning, and I'm pleased for that to go on the record. And I'm pleased for me to make the statement that Transparency Task Force would not exist if it were not for Chris Sear, who's going to be missed by many, many people for many, many reasons. More about that in due course. Transparency Task Force has a formal purpose as a social enterprise. Our purpose is to promote reform of the financial sector so it serves society better. We're all about the belief that sunlight is the best disinfectant, a phrase first used in 1914, the book by Justice Louis Brandeis, all about banks and how they use other people's money. Sunlight is the best disinfectant. What we want is for the financial sector to be transparent, to be truthful, and to be trustworthy. And we do believe there's a direct correlation between the extent to which the industry behaves itself properly and the extent to which people are willing to buy its products and services. It goes without saying that organizations are more likely to be more popular if the people that use them feel comfortable with them, feel they can trust them. And clearly, trust is a factor that's influenced by transparency. Tonight, we're going to have the benefit of listening to Shoaib Akhtar, who's the author of The Great Bridges Disconnect. I'm sure he'll repeat the point I'm about to make, but Shoaib is actually speaking with us tonight in his personal capacity, sharing his own thoughts and ideas about the nation that stood by as the city sold its soul. And after we've heard from Shoaib about his book, the motivations behind it, the key principles within it, his hopes and aspirations for the future, we'll open up the conversation to everybody and give everybody a chance to chip into the discussion we're about to have. I'm going to do this. I would like to propose that we have 1 minute silence for Dr. Chris Sear. It feels entirely appropriate that we do that. We're going to have 1 minute silence. Thank you, folks. Ladies and gentlemen, can I please invite you to put your hands together for two reasons. One, to welcome Shoaib to the mic. He's going to be taking the mic in a moment, but also for those of us that know and remember Chris, to show our appreciation to Chris Sear for getting the TTF off the ground all those years ago. Thank you very much indeed. Thank you, Chris. Thank you, Chris. Thanks very much, Chris. Shoaib, over to you. Thank you. Over to you.
Hello, everyone. Thanks very much, Andy, and very sorry to hear about the news about Chris. My thoughts are with Chris and family. Thank you so much for the opportunity. Really appreciate this, and it's an absolute pleasure to be here discussing the book. In terms of my background, I've been in the industry for about a decade now, mainly doing investment research. And the book was sort of written out of growing frustration with the way things are in terms of the health of the UK economy and the de-equitization of our stock market. And especially when you look at it in the context of the legacy which we had, the country that laid the foundation of the modern financial system. Its stock market is now sort of the companies are craving for capital, and the IPO situation is bleak as well. As we are all aware, now we are at number 25th position. We have been out of the number 10 race for 8-9 years now, and yeah, it's just really disheartening to see such state of affairs. Yes, there are some green shoots, which I will be talking about later on. overall, the main motivation behind this book was the growing frustration. When you, given, in my day-to-day job, I interact with the fund managers. I look at the stocks, I look at the funds, and I know the quality of the British businesses and the cash flow robustness and the balance sheet strength. And when you compare the valuation versus other markets, it just doesn't make any sense. And it's a bit of a shame that we have ended up in a situation like this. But I staunchly believe that the country and the market, it does have the potential to turn the corner. And we are seeing some positive signals already so far this year. And there is, I think, quite a bit in the pipeline. So without further ado, I would just like to go through a few slides with you, if that's okay. So, and part of the reason, another motivation for writing the book was the disconnect. When I say the disconnect, it's not the disconnect of the investor with the stock market. There's an element of cultural apathy. In Britain, we have lost that touch, that affinity, which we used to have. We don't know what now it means to own a share, and what it means to sort of buy a piece of a company. And an American investor has a very different affinity to Nvidia compared to a British investor would have to Next, for instance. Obviously, there is no comparison in terms of different, types of businesses, but we have sort of lost that element of tangibility and that sense of pride in owning British stocks. So just going to go through some slides. So the purpose of this discussion is what happened, what went wrong, just trying to connect the dots, and what's the roadmap forward, what can be done to sort of get things, back on track. So as we all know, London was once the beating heart of global equity market, one of the oldest stock markets in the world. Back in 2013, London Stock Exchange was responsible for more than 50% of IPO volume. That has now declined to less than 3%, which is a shame. And the stock market, in terms of its relevance, has now declined from more than 10% of the global share down to 4%. Listing situation is pretty obvious, but the IPO has been slow pretty much across the board. What makes us an outlier is not the IPO activity has been slow. It has been slow, but it has also been slower than other countries. But the thing which worries me the most is the aggressive selling out of UK equity funds. So it's not that new money is not coming onto the market. What we already have is being aggressively sold down. Excellent British businesses are being gobbled up by the big fish, by the private market, private equity giants, mostly offshore based, mainly US based. I don't blame them. This book is not written with a protectionist agenda. I'm not against foreign capital, but I think we need to have some sort of guardrails. And if we don't back the British businesses, nobody else will. And most of the the bids which we have seen and the situation that we have seen so far, it looks like the businesses are sort of being picked up due to very, very mispriced opportunities, which is a shame. And it doesn't send a very good signal to any budding investor or entrepreneur. Some of them would simply want to get onto the market, list on London Exchange with the view to get off with higher multiples. They no longer have this long-term view of sort of graduating into FTSE and backing the businesses and just having a long-term view, because they feel that other markets can provide them with better value, which is a bit of a shame, I think. So if I were to give you some stats, the UK household ownership of equities has declined from 22% about a few decades ago down to 5%. So we as a nation have become a nation of hoarders, not investors. We like to save. So there is a dedicated chapter in the book called The Cost of Risk Aversion. So we have sort of confused volatility with risk, which are two completely different concepts. And one of my industry sort of colleagues from Schroders, Duncan Lement, he has done a phenomenal research a couple of years ago, and he said there is about 330 billion stashed in cash ISAs. Had that money been invested 2 decades ago, actually since 1999, that would have generated about 500 billion, about half a trillion in returns. So that's the huge opportunity cost by not investing or deploying those funds. But that's a cultural thing that is embedded in the British culture, and the trend seems to have exacerbated after the GFC, because the new generation, many people who are born after that time, they are a bit more sort of bold. People who have actually suffered that experience, they have the availability bias or representative bias, so they remember that pain, and they have not sort of managed to move away from that. And the similar picture can be sort of painted for our pensions. The elephant in the room is obviously our pensions. We have about 3 trillion held in our pensions. They used to hold 50% in UK equities. That has now drastically declined down to 4%, or less than 4%. The way you look at it depends. Because if your key institutions don't back the British businesses, it sends a really bad signal. Nobody else will. And we have seen that over the last decade or so. If you look at the outflows from UK equity funds, if the bleeding continues, 2025 would mark an entire decade of annual outflows from UK equity funds. So the domestic sellers, the domestic investors remain net sellers. Look at the performance of the last 5 years, the FTSE All Share, it's generated about 92% total return in GBP, which is only marginally behind S&P 500's return of 102, and comfortably ahead of the global equity index, and also about 20% ahead of the European index, and about 40% ahead of the Japanese index, and 60% ahead of the emerging markets and Asia Pacific index. So we can't say that the performance has been poor. We've done really well in terms of performance, but the domestic investors remain net sellers of UK equity funds, which is a shame. And that is the point I have sort of tried to highlight, that other countries, they have this sense of pride in backing their domestic stocks. They even have this sort of enshrined in their legislation, like the Buy American Act, or the golden shares. So we have something similar, but we don't have something to the same extent. And I think another element which I have highlighted in the book, so these stats, for instance, they sort of paint the same picture, that the cost of risk aversion, the people would rather buy property because it sort of stems from school age. They have not been taught what it means to own a piece of the company. How does that relate to the economy? And what does it mean to back a local business? And how does that sort of convert into overall prosperity at national level? The financial services industry, our industry is the backbone of the economy. it generates more than 12% of the GDP. Every £8 from the GDP, 1 out of every £8 comes out of financial services. It gives 2.5 million jobs. So if we don't have our market, our industry, that would be a huge loss. And when you look at the AIM market, AIM was supposed to be our answer to NASDAQ when it was being put together. So it started off really well, but since 2007, as you can see, the number of companies on AIM has halved. That's partly due to regulatory issues, due to transparency issues, due to poor marketing, especially in the post-COVID world, when Americans bought shares with their stimulus checks. Our government didn't market the AIM as the next big thing. British investors or the general public weren't incentivized by the government. Why don't you back these businesses if you spend, these are we just weren't incentivized. I don't think this could have been a completely different story had that happened at the time. So again, that comes down to the cultural element. We look at it from a very different perspective. So over the past decade, some of the UK's best known firms have been sold to overseas buyers with the likes of Arm, Magid, Tetra, Morrison's. The pattern is predictable. Buy is under-owned, under-researched. A foreign buyer would come and just gobble it up at a much lower price.
It looks like we might have a bit of a technical glitch there. Whilst we're waiting for Shoaib to return, I'd just like to sort of fill in the gap, as it were, until Shoaib does return. I think he's got a bandwidth problem. I just want to put a provocation out there, and it really leads on from some of the items that are being put in the chat. The provocation is, to what extent are the UK public turned off from investing because of the adverse publicity they routinely see? If, for example, we just think of the Woodford investment scandal, which I believe impacted about 300,000 people, a fall from grace of a rock star fund manager, super successful, lots of people following his lead, lots of people investing in his funds, then a massive catastrophic failure. No need to go into the details of that today. But the amount of adverse publicity that occurred around that was huge. JB, why don't I ask you a question? Perhaps Con would like to follow up as well. JB, to what extent do you think investment scandals are a contributory factor in what might look like the demise of the UK investment market?
It's a good question, Andy. I won't speak to that particular case if you don't mind.
Of course, of course.
But is the demise of the star manager culture in the UK, and the biggest of those star managers being Neil Woodford, did that then coincide with the rise of indexation, exchange traded funds, and the demise of this idea of active management beating the markets?
Yeah.
The answer to that we could observe is absolutely yes. And I think it had two effects. One, it did reduce confidence that active management could outperform markets over the long term. So that would, when you think the majority of assets being held in UK equity ostensibly were in large active funds, it's certainly in the retail space. But also it totally changed the game in that because the index industry was so successful in pushing its message that actually you're better off investing in the broad market by just tracking the index rather than going with an active fund, all of the collateral, all of the messaging tended to coalesce around the S&P 500 because that's where they had the longest running data going back to the Spiva reports, the original Spider ETF, which S&P 500 ETF, and of course Vanguard. So all the material, not only did it convince the general public that active management might not necessarily work, but it also suggested that you'd be far better off in the US stock market because that's what all the material used to talk about. It didn't talk about investing the money in a UK FTSE tracker. It talked about putting the money in the S&P 500. So that's the retail story, and I think you're absolutely onto a right point there. There was a denigration of trust, but also timed with this shift towards index investing, and we can see how that money is massively shifted across. The structural issues in the pension side were different. People will point to things, for example, the stamp duty, for example, which actually disincentivized pension schemes investing in UK companies and actually moving the money elsewhere. But actually, that wasn't the biggest structural change. The biggest structural changes happened in many ways. One, it came through actuarial and capital modeling assumptions, basically, which were, by the way, effectively an oligopoly, a US oligopoly of large consultants that were telling pension funds and telling workplace providers where to move their money to. But you also had a lot of investment support to move that money to move towards the dollar, to invest into big tech, areas where these things were underweight in the UK market. And of course, we've seen this over this last 5-10 years, this massive shift to environmental social governance. And the consequence of the shift to ESG was, again, actually pension schemes and investors divested from the UK because they were, quote unquote, heavy in oil majors, heavy in miners, and again, moving away to companies with better ESG ratings. And that all kind of culminated in this kind of drive of money out of the UK into the US. And these things don't happen like a light switch. These things happen iteratively, and they tend to happen in cycles. So what happens after the GFC, the US recovers more strongly. What happens after the Euro sovereign crisis, the US seemed to be in a better place. Why? Because it had a more liberal regulatory culture and a much more liberal system supporting the banks, supporting asset managers. So there was lots of structural issues why this happened. But I think we have to reflect that the reason a lot of the money flew out of the UK was because they were being told on an almost daily basis by firms in the United States that was a very good idea to do that. And becomes a bit unfair and complete in that respect. I'm sure Con will have a different view on that, but that's certainly where, in my seat, that's how it played out where I was sitting.
Toby, thank you for your thoughts. Con, over to you. What do you think about all this?
I do have a different view of why we've seen the decline that we have seen. The first thing to remember is there's no point in looking at any of the numbers before 1981. It was 1979 when we removed exchange control. Exchange control basically limited the ability of any UK individual or institution to buy foreign stocks or to make foreign investments. And it was fairly punitive. I mean, when I first started trading dollar premium, it was over 100%. So to buy a US dollar, you didn't have to just deal two, you were actually dealing at effectively about half that rate. Now, so yeah, you can't compare anything that went on before. We then got Big Bang, which was a very heavy American influence on the London market. And of course, the demise of the thing which was most important for the dissemination of information, the long and extremely boozy lunch. Now, the 90s saw a shift, which I think is important. Rather than using the London market and new listings, IPOs on the London market, as being a place to raise capital, what we actually came to see was the market was predominantly somewhere where companies came to cash out, not to, that's cash out their existing shareholders. The other thing which we saw over that period was a
Hmm.
noticeable decline in the age of the companies, the average listed stock was far older, was in Rust Belt industries, lots of petrochemicals, lots of chemicals, um, and UK real estate. Why did we see the demise of the individual? I'm not really sure, but I think that part of it was a lowering of tax rates. Because once you start lowering tax rates, and I mean, I actually paid tax at one point in the 1970s at over 90% of my income.
Wish
Uh,
I
at,
wish I did.
at that level, it really doesn't matter a fuck whether you're earning 12% or 8,
Mm,
right? Because you're seeing so little of it, it really doesn't matter.
mm.
Yeah, the name of the game was get your money out of the country in some method, which was, if not illegal, certainly close to. The the problem we really had on the institutional front was twofold. First of all, the regulation of insurance companies basically precluded any of their regulatory capital because of the weights applied to equity holdings, that any equity to be held by insurance companies. And you see, even to this day, insurance companies hold only token amounts of equity in their own funds, investments. That was combined with the absolute crippler on DB pensions, which were far and away the majority of the UK pensions market. And in particular, the pensions regulator promoted the use of liability driven investment, for which read buying bonds, not equities, to the point that we ultimately had a disastrous recompense around the time of the trust budget. And
Right.
the trust budget was just the blow off at the end of the thing. Half of the losses in the UK pensions market in 2022 had actually been incurred by July of that year. The trust collapse was in September of that. That was the response to Kwasi Kwarteng's budget, the which actually was handled very well by the Bank of England. It was and has been stabilized. Um, liability-driven investment is still a major factor in the DB pensions market, and it shouldn't be. The DB pensions world is seriously overfunded, and if you look to local authority funds, which are not regulated by the pensions regulator, you'll see that they hold a lot more UK equities than does their equivalent in the DB sector or private sector DB. That's sort of where we've got to. Let's just deal with AIM. Yeah, looked I looked to AIM, and I've seriously thought about investing in AIM in various stocks. And I used to get the prospectuses of every stock that came to London. Also, 4 years of diligently reading every prospectus that came my way, I found only 3 stocks that I thought were worth investing in. Okay.
Hmm.
There. All too many of those stocks were a wing and a prayer and a following wind needed to actually survive, let alone prosper. It's all going to change. Well, I don't think so. I'll tell you why I think that we have real problems now. That's the advent of yet more new technology, tokenization in particular. Um, we've talked about tokenization actually displacing a lot of listed equity and a lot of trading activity. This has not been the case until recently. But we've just seen JP Morgan tokenize a private equity fund. I can tell you that I'm aware of, we've also seen NASDAQ filing to begin offering tokenized securities on all of their listed shares. So there'll be a blockchain with the tokenized variant of their listed equity trading alongside. So NASDAQ will capture all of the activity, either in listed traditional format or in token format in those shares. Now, the costs of transactions in tokenized format are going to be minuscule by comparison with traditional costs. Then when we come to London, well, I know that there is a London equity going to get offered in tokenized form. I don't know if I'm allowed to say. I'm led to believe that it's going to be 3i, Investors in Industry, as used to be. It's going to be tokenized later this year, and it's going to be done by a US technology firm and offered using US, basically ADR technology or ADR legal form to offer that. That means that a block of III stock will be immobilized and not available to trade. It, I suspect, means that the stock will then have more volatility here, and a lot of its trading activity will tend to focus in the tokenized form, and so on. Now, then we've got Clearstream, who have just announced that they are going to start offering token clearing, and in particular, they're looking at things like bond issuance, and they see no reason why this couldn't extend to equity. Now, I'm actually working with a firm that is looking to tokenize a few real-world assets, which we'll be doing in the course of next year. And we have had extensive conversations with the London Stock Exchange. They usually consist of us calling them up, us going to see them, and then silence ensues.
Mm.
We have decided we don't give a flying fuck about London. We are going to have ourselves FCA registered. We're going to have operations in Dubai, Athens, Singapore. I've missed somewhere. Anyway, and the London, which could have seen a great deal of activity from us, is absolutely nowhere in competing with the moves of people like SIX, the Luxembourg Exchange, or the Singapore Exchange. I would say the best thing that could happen to the London Stock Exchange is to have one of those exchanges buy it.
Wow. Powerful stuff, Con. Thank you very much indeed, Con. And thank you also, JB, for chipping in earlier whilst we lost the connection with Shoaib. Con, you put out some very significant challenges there about the role of the London Stock Exchange moving forward. Shoaib, we're back with you. Are you able to share your slides again? If not, I've got them here and I could share them for you.
Yeah, my apologies.
That's okay.
I'm afraid I can't. We've lost the internet in the office.
Okay.
So I'm on my mobile. So my apologies.
Okay. So what we're going to do, I'm going to access your slides, okay, and then you just tell me when you want me to move from one slide to another, okay? All will be good. All will be good. So bear with me. There we go. We're quite used to dealing. We're quite used to dealing with unexpected situations here. We've done a few of these events over the years. So here we go. That's the next slide. That's the one past where you were. Okay. So tell me when you want to move. Shoaib, over to you. Thank you very much.
Many thanks, Andy. Yes, I was talking about the AIM market and the persistent sort of shrinking and the slowdown in the IPO market. Yes, pleasingly, we are seeing some pickup in the activity in the AIM market. There are 16 new IPOs this year. compared to 8 and 5 in the last couple of years. But we had 300 IPOs back in 2006. So this is, yes, pleasingly it's picking up, but it's nowhere near what it used to be. AIM, and obviously the recent government legislation hasn't helped. The removal of 50% of IHT relief is the equivalent of sort of pulling the rug from the feet of those AIM investors. And the market and this particular space remains very vulnerable still. Personally, I'm watching this space very carefully. I still believe that we need to back this market, and this could be a really good sort of ground for budding companies to sort of graduate into the main market. But as things currently stand, the picture is a bit bleak, but I'm not giving up. There is plenty of capital going around, but apparently at the moment, none of it, wants to do anything with British stocks, which is a shame. But some of the noises from the Chancellor have been really, really encouraging. Tell Sid and all those sort of rhetorics. I saw a little glimpse of that a few months ago when the Chancellor was up north. So we need more of that. And if you wouldn't mind, please moving to the next slide. Yeah, and the next one, I think I've dealt with this as well. So yeah, that's the key one. This was actually one of the key motivations behind writing the book. The bleeding never stops. When you look at the Calastone data every month, almost hardly a month goes by when there are no outflows. And the frequency of outflows has sort of intensified over the recent past. In 2024 alone, we lost 9.6 billion, which is a staggering number. If you look at the data over the last 10 calendar years, the outflows from UK equity funds sort of amount to approximately 60 billion. So that is 1/4 of FTSE 250's total market cap. That gives you an idea of the scale of the rout which we have sort of witnessed. And the performance has been, if you look at the FTSE All Share, as I mentioned earlier, the performance has been excellent. Yes, SMID and AIM have been under pressure, but we are all aware of the rationale and the reasoning behind that. And part of the reason is poor marketing. There is nothing wrong with the quality of the businesses, but we don't market it properly. And some of the actions by some of the key giants like the likes of AstraZeneca, talking about moving their secondary listing to New York, that still sends a very bad signal. And obviously, if our key institutions are also herding towards LDI and loading up their portfolios with bonds, then that doesn't help either. So when I say we have become an outlier compared to other markets, this is part of the reason why we've become an outlier. It's not just the slowdown in the IPO activity, which has been the case pretty much across the board, especially over the last 3-4 years, because the rates have risen. So it's difficult to sort of IPO due to restrictive costs. But here in the UK, another important element, which is part of the reason I believe we have become an outlier, when you look at the M&A activity, the bulk of the M&A is inward here in the UK, as opposed to the outward, which is very healthy. Last 4 years, you look at the M&A and the data, 60% of those takeovers were from US, predominantly US, and more than that, overseas, which means so we are not just we have not just stopped raising new capital or increasing the size of the stock market through the IPOs. We have been aggressively selling it, and our pensions, have sort of led the way. So it's a bit of a double-edged sword. So on multiple fronts, our stock market is has been under pressure, to the extent that I was looking at the recent data a couple of days ago. in terms of IPO activity, Oman, the country's stock market, which is less than 2% of UK's stock market in terms of market cap, they have sort of raised more funds so far this year compared to the UK. Mexico has done better than us. Singapore has done better than us so far this year. We are at number 25, 25th position, which is just a shame. And if you please wouldn't mind moving to the next one. So this bleeding needs to stop, and this will change when there are some positive signals, from the key institutions. There are some sort of green shoots that the British stocks are worth buying. So it's a cultural shift that needs to happen. Without that, it will be very difficult, I believe. Again, the pensions paradox, I've touched on this before. There is so much money to the tune of 3 trillion held in the DB pensions and the DC pensions. Bulk of that is in DBs. The 3 trillion is just slightly more than the total market cap of the total UK, stock market. That gives you an idea of about 50% of those pensions assets were held in UK equities back in the 90s, and now it's a meager, 2-3%. So it's not that there's not enough capital. There is plenty of capital, but it just doesn't seem to be for British stocks, which is a shame. So unless our key institutions, and part of I think we're going to move on to the solutions later on at next slides, if you wouldn't mind, please, Andy. So yeah, so this is how can we sort of turn the tide? What are the solutions? I have proposed 10 key points in the book, which are all very practical and easy to implement, I believe. And the main focus of those, the key solutions which are proposed, the key point is the UK equity exposure disclosure. So I am all in favor of mandating exposure, not mandating allocation. I don't believe that's not a very British thing to do when you are forcing pensions to invest a certain percentage in UK equities. I'm not in favor of that. What I'm in favor of that is mandating the disclosure of how much do they currently hold in UK stocks and other equities. That disclosure alone would be very helpful in terms of generating awareness in the wider public. If people don't know where their pension is currently invested or how it is currently invested or what type of businesses their money is backing or funding, they don't believe they have an agency. Without an agency, there is no reaction, and there is no sort of concern without an agency. So in order to create that sense of agency, having a mandated exposure from these pensions is what I've so proposed. Another is the British Growth ISA is incentivization for investing in domestic stocks, especially those stocks which generate the bulk of their revenues domestically. The FTSE 250, SMID, AIM stocks, all of these. This could run alongside the standard ISA, or we could produce the cash ISA allowance and sort of come up with something like British Growth ISA just to prop up the British businesses. Many other countries do that, so that is not a protectionist stance at all. Another thing which that requires quite a bit of manual intervention, the UK Stewardship Index. That is something which I've personally been working in my spare time. I've got a full-time job with 3 boys at home, so it's difficult, but I am trying to sort of put together a dashboard of various platforms and providers and trying to come up with a ranking system, like a platinum ranking for providers which have more than 50% in UK equity, 30 to 50% gold ranking or gold ratings, for those, and then is sort of on a tiers structure. This would be also really helpful in terms of raising awareness, and people or these firms hopefully would be competing. I don't believe in name shaming or anything, but I think this could be a healthy competition. Another proposal is UK equity loyalty bonus. Anybody who buys UK shares could be given CGT relief. The CGT relief could be staggered over multiples of financial years. The longer you hold, it sort of tapers off. That could be a good way to incentivize people. And another very important one is the financial literacy. Starting off, from school. My son is 9 years old. I have already started talking to him about investing. What does it mean to have a small piece of a local supermarket? How does it help the local economy? How does it help the national economy? And what does it mean to back the British businesses? Why you should buy British stock? How is this going to trickle down future generations? And how is going to lead into prosperity at the national level? So the kids at the moment, they have absolutely got no idea when they come out of school. Even when they come out of colleges, they have no idea about the opportunity cost or how does compounding work. So introducing mandatory financial literacy at schools, I think that would be really, really helpful. So this was another key proposal. There are a few other proposals in the book, but I believe these are the key ones. And there are some green shoots. So far this year, we've seen Shawbrook recently, floated. Obviously, the market cap is over $1 billion. They have only raised to the tune of 50 million, but still, it sends a psychological signal to other participants that London is worth backing, and we have got I want people to be getting excited at the moment. Even you look at the American president, he gets so excited when he talks about his stock market. And being the leader of the country, even a normal American, you look at them, you talk to them, they are very excited. They have this sense of pride and in ownership of their domestic stocks. One thing is when you have inferior quality stocks or businesses with high debt levels or leverages or poor cash flows, we don't have that. Largely, we have very high quality businesses, very high quality stocks, but we haven't really marketed them properly, and that's why we have ended up in this situation. So we need to change this cultural shift. We need to make people excited about buying British stocks. At the moment, people are just giving up. Many people are sort of relocating to other countries. I was reading just a couple of months ago that in 2025 alone, 16,500 millionaires are due to leave the UK, which is twice the number of millionaires which are due to leave China. And when you compare our population with China, that gives you this the degree of distrust, I would say. And so the government needs to take this very seriously. We have the highest amount of millionaires on earth projected to leave the UK in 2025 compared to all other countries, including China and Russia as well, 10 times more than Russia, twice the amount of China. So the Great British Disconnect has been written from place of concern and to sort of contribute to a growing conversation that unless I come from Pakistan, I've lived here for about 20 years. If you have experience of other countries, then you would appreciate it more, that how much do we have here. We have got so much capital, we have so much potential here, so much intellectual talent. We just don't have the conviction, and we need to have that conviction to turn the things around. And it is very, very possible to turn things around. We've got all the ingredients to have a very good recipe. Thank you.
There's one more slide there, show it.
Yeah, I think it as I mentioned earlier, financial services is one of the major industries and one of the key drivers of growth in our economy. So if we were to lose our stock market, or if a stock market were to become a peripheral or a satellite of other global markets, it would be a huge shame. 2.5 million jobs in financial services. It represents over 12% of the GDP. It sort of generates 100 billion in terms of taxes every year. So it will be a great loss. And the Chancellor and people in power, I think they need to take this seriously. It's not just the fund managers who will be losing their jobs. There are so many people connected to the industry in IT, in administration, in so many other sectors whose jobs will be affected if this sort of happened. But the way things have been going is slightly alarming. Yes, there are green shoots, but we need to take this seriously.
Thank you very much indeed for talking us through your slides in your book. Thank you very, very much. There's so much we can come back to you on. Can I please put a question to you, Shoaib? So, to what extent is the problem the product versus the marketing of the product? You seem to indicate on a couple of occasions, at least, that we're not selling what we're good at very well, but the actual product itself, if I call it the product, is actually pretty good. Is it the product or is it the way we're promoting it?
I think it's the latter. It's just we have not been promoting it in a manner the product deserved to be promoted. When you look at the stats, when you look under the bonnet, when you look at the financial metrics, the product is of superior quality. It's just the marketing has been poor. And so much more can be done at a national level to sort of reinvigorate and develop that culture of backing British businesses.
Thank you. Would anybody else like to come in on that particular point, product versus the marketing of? Martin, I see you've got your hand. Please do go for it. Thank you.
I guess product here, we're meaning the Great British Company, aren't we?
I guess not just the company, but also the means by which people can invest in the company, the mechanism through which they can invest.
Nodded his head when I said that. I think the question is twofold. One is, are there good companies in the UK that are really worth owning? And to me, a good company earns a decent rate of return on capital and it exports profitably, because we have a major issue about our ability to pay our way in the world, and the companies worth owning have got to be able to export. So that's one point. And the other thing, which I think we've touched on, apart from Con's devastating point that history started off with being forced to invest in the UK for a long time, I find that really rather major point, is that we just don't have the depth of equity investing that we used to, now that we've lost DB pension schemes, and the rates of saving going into other forms are less. And I know it's one of Mervyn King's frequent laments that we just don't save and invest enough in the UK. Another thing, I'm sorry to do this, another thing is the extent to which British companies are run in order to survive in the long term. Our executive pay, etc., rather causes short-termism. I don't know whether you cover this sort of thing in your book, but that's plenty. I'm sorry to say so much.
Thanks, Martin. Shoaib, do you want to come back on any of those points? And if you see, I've put a question in the chat as well. Does Brexit feature in all of this in any way? Has Brexit been a good or bad thing for the UK's investment industry? So, Shoaib, back to you on those points as well as what Martin just raised. Thanks.
Oh, thanks very much, Martin. Thanks, Andy. Yeah, really good questions. And yes, I think I will start off with Brexit. Yes, because in 2015, we had net inflows into UK equity funds. Ever since Brexit, from the year of Brexit, we have not had a single calendar year of net inflows into UK equity funds. So ever since, the bleeding has since continued and it still hasn't stopped. So yes, I believe Brexit has got something to do with that. But
Well,
every country goes through sort of ebbs and flows, all these cycles and changes. I think the quality of the companies is very good. Largely, yes, there are outliers. Yes, there are certain stocks which can be a little, a bit of a value trap or mispriced. But largely speaking, when you look at the price to earnings ratio, or the cash flow, or the yield, or the ROIC of an average British stock or our index compared to other indices, is very much high quality, and in terms of price is very, very attractively priced. And yes, the CEO pay and all of these, I think that's personally to me, you find those sort of instances everywhere, even in the US. But largely speaking, the quality of the businesses is very good. Why I say that, in order to, the proof is in the pudding. Whenever these companies move to the States or elsewhere, they do very, very well. And they only struggle on the local stock exchange because we don't have a proper backing of these businesses. As soon as they move abroad, they sort of grow into multiple folds. So the proof is in the pudding. There's nothing wrong with the quality of the businesses, largely speaking. We have stopped backing them.
thank you,
Can I just
Shoaib.
come in? Andy, can
Please
I
do.
just come in here?
Please do, Con.
The-
And after you, we'll go to Robert Delner after that. Thanks, Con. Thank you.
Let me just add a couple of points. In the chat, I think you asked Andy, what do we do if we lose AIM? Well, yeah, we have a new exchange being offered or forthcoming from the LSE, Pisces. Now, I had to speak to 4 different people at the exchange before I found one who could tell me what it was, and then his description was pretty incoherent. So I actually have to tell you, I don't know what it's going to do.
Mm.
The other thing to understand is that we do have an extremely vibrant VC market in this country, particularly for university spin-offs. There is no shortage of funding for those businesses. It's true that many of them find it hard to raise the follow-on capital to move to middle-sized and similar companies. And at that point, there's a lot of them get sold out to foreign buyers. I don't see that there's anything wrong with that as long as we are still producing university spin-offs at the same rate. And there's no slowdown in the rate of spin-offs. In fact, if anything, there's an increase. So I wouldn't get carried away by the idea that we can't do things. As for exports, I'm not sure whether you actually want to require exports. I can think of lots of businesses where exporting doesn't figure at all. Mainly in, for example, medical services. Unless you want to include supplying medical services to tourists or medical tourists or whatever. But the export requirement, I think, is a red herring, Martin. And to answer your question in the chat on what's tokenization, a token is simply a representation of a security on a distributed ledger or blockchain. That's all I wanted to say, Andy.
Thanks, Con. Thank you very, very much. Very definitively put that last point. Mr. Robert Delner. Robert, lovely to have you with us. Robert's written a great book about integral investing. I'll find a link to it and I'll put it in the chat. Robert, over to you.
Just a quick question, really. Thanks, Shoaib, for your presentation. I put it in the chat earlier, but we're just curious on your views. What about dual listings? Is it a solution for companies to harmonize price and values across markets? and some form of arbitrage, at least mental arbitrage between various markets in terms of pricing? Or are there barriers why companies don't have an effective dual listing? What are your thoughts? Thank you.
Thanks very much, Robert. And my apologies, I don't have access to the chat. I'm on my phone, so I can't. My apologies.
Sure, yeah, no worries.
So in terms of listings, I personally don't see much harm in dual listings. The only thing which sometimes worries me when companies move their primary listing to a different country, and if they see an improvement or a material improvement in the pricing or the perception of the stock price, then there is a danger of them permanently moving there. And also, if firms like the likes of AstraZeneca, this is, I'm not sure if it still is, I think when I checked last, it was the second largest or the largest stock in FTSE 100. If firms like this sort of go down this route, it doesn't sell a very good signal. To me, it sends a signal of loss of conviction and confidence in the local market. Given the way things currently are, I would rather other firms, like Wisma, recently, I think that they're planning to do that in 2026. They're coming to London. So I would rather this trend to reverse in favor of London rather than the other way around. But personally, I don't see any harm in that. Thank you.
Thank you.
Thank you, Shoaib. Thank you, Robert. I'm going to share my screen because I want to take a look at some data in Violation Tracker, because I personally think we are doing a bad job as an industry encouraging people to use the industry because of the way that we allow so many infringements to happen again and again and again. So this is Violation Tracker. Many of you will know Violation Tracker. It's a database that aggregates corporate infringements. One of the many searches you can do is to ask it for the parent industry summaries. So let me show you this, parent industry totals. And what it's showing us here is a listing of the different industries in the UK ranked by how much they've been fined. As you can see, the financial services sector is at the top of that list, over £6.5 billion of fines since the year 2010. Not only is it at the top of the list, it's the top of the list by a long, long way. Aerospace and military contracting, brackets mostly fraud stuff, close brackets, is just, inverted commas, £1.5 billion. So there's a huge gap between the first place and the second place. But if you then click on financial services, as I've just done, you see the top 10 worst offenders: UBS, NatWest, Barclays, Lloyds, Deutsche, JP Morgan, HSBC, Citigroup, Glencore, MasterCard. They are the 10 worst offenders ranked by how much they've been fined over the last 10 years. But then you have the individual fines. And if you scroll down the list, you start to see a pattern. It's a pattern of recidivism. The same organizations being caught doing the same things over and over again. And to my mind, ladies and gentlemen, this brings to the surface a question: is our regulatory framework failing? I pose that question because if the purpose of the regulatory framework is to bring about good market conduct, if there is recidivism, i.e., organizations getting caught and then carrying on misbehaving, surely that must point to regulatory failure. And what's all this got to do with what we're discussing this evening? I can't get away from the idea that all the time there are scandals, all the time there's publicity about scandals, all the time there are investors who've lost out. For example, Woodford, 300,000-ish people lost a lot of money. There's going to be an adverse effect, surely, on the demand side, people being less willing to invest and save. And if you compare things like the Edelman Trust Barometer, if you compare it how trustworthy people feel towards the UK financial services sector compared to, for example, the Singapore market, you will see that there are different parts of the world where people feel more and more confident about their investment markets, confident in terms of the belief in the underlying integrity of the markets, the regulatory competence. Shoaib, is this something your book has touched on at all? Have you looked at the consequences of market scandals, be they investment scandals, auditing failures like Patisserie Valerie, Carillion, etc.? Does the book look into that kind of dampening effect on the demand side, people not wanting to invest because they don't trust the investment markets and the investment paradigm? Shoaib, what do you think on that?
Thanks, Andy. That's a really, really important element to highlight. The book doesn't go into that much detail, but it does mention the frequency of fund houses or fund managers shutting down their shops has sort of been on the rise over the last few years, and that is mainly due to the regulatory burden and so many administrative requirements for managers to keep up with. So that is the bit of sort of I've highlighted in the book. And yes, I think that the financial literacy element and the way to encourage people, that's a very good sort of challenge. The part of the reason people are not willing to invest domestically is that maybe there is the sort of lack of trust that needs to be sort of reinvigorated, I believe.
Thank you. That's interesting stuff. Mr. Martin White, back to you.
Sorry. On the financial literacy angle, yes, if people were more financially literate and trusted the system more, then we would be getting more investing in equities, I'm pretty sure. But if people were more financially literate, then they would know that it's not worth paying for active management, it's worth paying for passive. And they would know it's not worth paying a percentage of your wealth to an advisor, etc., etc. And in that world, we may have more investing, but we may have a lot fewer profitable jobs in the city. What do you think?
This is a very good question, Martin, but I would say yes, last decade, especially since the GFC, has been very, very difficult and challenging for active managers. And there is a tremendous amount of pressure pretty much across the board in our industry in terms of fees. We're talking about, bips, how many bips can we save? Yes, part of the reason we have ended up where we are is also due to the passivity and people chasing benchmarks. Even when you look at the way the models is, the way the consultants build their strategic asset allocation models, and the way the optimizer works, it naturally favors the stocks which have done well or the stocks which sort of form the bulk of the market cap of the world. So that sort of goes against the UK stocks. Yes, that's a very good point that people will be thinking about the cost element. But when you look at the value active management can add over the longest time frame, over the last 20-30 years, then it sort of tilts in favor of active management. But the case has been weakening for active management, particularly in the US. It's very, very difficult to beat the US market from an active management viewpoint. And the other point around financial advisors, I would probably disagree there, because a good financial advisor can add real value, especially if your financial affairs are quite complicated with the IHT and with other affairs. Obviously, yes, I'm PFS qualified, but I'm not.
I'd pay them a fee for their time, but I wouldn't give them a percentage of assets, and I wouldn't give them a recurring percentage either. I'd pay them just like solicitors for their time.
Fee. I'm all for fixed fee. Yes,
which is a good way to act in a way that engenders trust rather than hidden earnings.
Yeah. And again, this is my personal view. Yes, I agree with you, having a flat fee.
And that relationship between the buyer of services and the seller of services has to be right, because if it does incentivize lethargy by the fund manager, that's what you're going to get. Interesting stuff, Martin. Thank you. JB, back to you, sir.
Interesting conversation, and Shob and I have had quite a few of these over the last while, and I've been a big supporter of his new book. I've written before that the US is holding all the cards, and the UK in many ways, and there's two things I'm going to talk about. One, the UK in many ways was the world leader of what a regulated, orderly financial system looked like, that was transparent, fair, and properly accounted. In many ways, things like the Retail Distribution Review, where we segregated product fees from advisors, the shift towards cost transparency, the removal of commissions. All of these things were based around a sense of UK leadership. In many ways, EU rules often was in either lockstep or actually trailed many of the developments by the UK. The US went in a very different direction. Advisors are often still paid commission in the United States. Fund fees are almost as high as ever, despite the fact that they formed the original assessment of value process that the UK then later copied. But profits have never been so good. Controls have never been so slack. The SEC as a regulator has been denigrated since Trump's come back into administration and has even less teeth than it used to. And yet, all the money flows to the United States. And we need to stop and ask why. Is that just a function of deregulation and liberalization? You know, these are the neoliberal playbook. This is what everyone says, well, if you take out the red tape, everybody wins because the friction becomes less. Everyone can then grow the profit. And don't worry about the few victims that maybe suffer along the way. That's okay, but for the greater good, everyone makes more money. All the money flows in. And we have to try and reconcile what that means post-Brexit, because after Brexit, we had two choices. We either gold-plated ourselves as a financial market and hope that therefore global money would be attracted to that on grounds of safeguarding, on grounds of trustworthiness and what have you, or we follow the United States down the deregulation rabbit hole. And for a while we teetered, and now we seem to now be following the United States. But I suspect it's all too little too late to try and do that sort of thing. Again, I would say the United States holds all the cards. And someone in the chat group actually posted about the Brexit question. Dare say, was it you, Andy? Did you post the Brexit question? I think you did. And I just put a little bomb emoji next to it because I thought, well, it's politically charged. But one thing, you know, that Shob and I have talked about is we underestimate this idea of capital gravity. And what I mean by that is once we went through Brexit, London overnight lost its primacy as a clearing market for the global capital model, the global capital system. And we shouldn't underestimate what that gravity does. If you have that vast money coming through in the clearance center, you have the legal apparatus centered around protecting that clearance system, it attracts money. As soon as you lose the efficacy of that clearing system, the reason that money flows from the United States through the UK into Europe and Asia, once you lose that gravity. And as a consequence, you lose then that focus of investment and capital in London. And that's what helped support the system. Once Brexit happened, you remove that support level. So I think Brexit had a number of negative consequences for the UK. One was the regulation issue, but the other was the loss of the clearing primacy.
That's
Just
really
come in
brilliant,
on the
David.
Brexit. Sorry, and can I just come in on the Brexit question? Swati Dhingra from the Bank of England gave a speech last week to the Bank of Ireland. It's on the Bank of England's website. In that speech, she reports research which shows that the cost of Brexit was not the 4% hit to GDP that was expected, but something close to double that, around 8%. And that many, if not all, of our problems since Brexit, or rather since the exit, have actually arisen from Brexit. Yeah, there you are. Anyway, yeah.
That's really
Yeah.
interesting. I think I've just found that speech, Con. I think it's this one here. I'll put a link to it in the chat.
It's
Is that the
called
one?
Tariff with the Same. Yeah, that's the speech.
Okay, I'll put that in the chat. That's significant number, isn't it? 8%. Crikey. Thank you very much. Thank you.
Your speech is extremely good, by the way.
Interesting. Very, very interesting. So one way of kind of describing this is to say that there's a multiplicity of reasons why the UK is hemorrhaging investment capital. And the important point is there are things that can be done about it. It's not like our hands are tied. Shoaib, when you went through your slides, you presented, I think it was 5 ideas, all of which actually seem to have real practical merit. I'm not just saying that to be nice, but I can imagine every one of them making some kind of a difference. And if you aggregate the compounding effect of doing all of them, there's real value there. Tell me, have you attempted to get the Treasury or the government to look at these ideas in some way?
Thanks, Andy. Yes, I am planning to send hard copies of my book to members of the parliament and to the relevant people. This was my very first book, and due to a very busy schedule, I'm putting together, all the logistics and trying to find a way to get this book in front of the relevant and right people. But at the moment, I haven't sent it around, but the book has been read by some of the people from some members of the parliament, without naming any names. The idea is to send them some hard copies in the next few weeks' time. I'm planning to do that.
That would be a great idea. I see there's a note from
Can I
Danny
just come
saying
in?
Ian
There's
has
one
his
other
hand
thing
raised.
which is not, Andy, there's one thing which has not
Yep.
had a single mention. We've had a number of attempts to increase investment in the UK. The Mansion House Accord or the Mansion House Agreement from Sir Nick Lyons, then the Mansion House Accord, and most recently the Sterling 20, which basically consist of groups of pension funds and insurance companies who are promising to invest more in the UK, up to 10% of their assets in private placements, with half of that going into UK investments. The ABI did a progress report on this just recently, and the total increase in investment from this group of 17 fund managers was actually 0.25% of their assets under management. So those things are having no effect whatsoever.
Really interesting. Really interesting. Before we go back to JB, I think it may have been Ian Robertson, because Danny says Ian has his hand raised. Ian Robertson, did you want to come in?
Yeah, actually, if I come back on 2 points. The first one actually on the Mansion House issues. I mean, this is clearly the government is going to be trying to nick some money from pension funds to pay for infrastructure. It's a grab. So I'm not really that sure that the public equity market should be wanting to get involved in it. And on the other issue I'd like to sort of point to is the FCA regulates to protect the FCA. It doesn't regulate to protect anybody else. It is massively underfunded. A few years back, for a joke, given my background in AIM, I went along for a job, supervisory director role there, and they didn't have a clue what is going on, but they're absolutely certain that what matters is they protect the reputation of the FCA and that it is made clear to everybody that they're doing a jolly good job. And that's consistent with what we see with the LSE and AIM, who have the right to regulate what they want to regulate and disclose what they want to regulate. So what you see on your register of failures and frauds and what have you is not really relevant as far as the equity market is concerned, because there's plenty that goes on that never gets to see the light of day, because no one wants it to see the light of day, because it destroys the credibility of the equity market and the fund managers, because it's in their interest to keep their gobs shut when they've been legged over.
Wow. Well, that's interesting. What was your background in AIM, Ian? Forgive me for not knowing.
Yeah, my background was started off as a small cap fund, well, I was accountant and a small cap fund manager. then I went to the dark side as a broker on AIM. So I latterly in the market, my role was as head of the research, most of the equity side of a company called Seymour Pierce, which was one of the largest brokers on AIM, had an interesting track record, shall we say. We had a very light touch from AIM, even when my colleagues on the board tried to sell the firm to the Russian mafia, AIM didn't want to get involved. And there was only one reason why the Russian mafia wanted to buy the largest broker on AIM, and that was to fleece the UK market with corrupt businesses. But try and get a conversation with AIM, been trying for 15 years.
My goodness me, that's really interesting. We're going to go to JB, and then we're going to go to anybody else who's itching to chip into the conversation. Then we're going to go back to Shoaib for his final thoughts and reflections before we wrap up the session. JB, back to you, sir.
Yeah, a relatively quick one. I think everyone will be pleased to hear. The Mansion House, obviously the Compact and the Accord. I do work with a top 5 ABI firm in an independent capacity. Chatting with the people who are in the lobbies who sort of decide whether these firms are going to sign up to these government policies. From the pension company's point of view, it was seen as an easy win because of the way the Mansion House was written. They were able to include existing assets. And because they were essentially unlisted in nature, which goes completely against the grain of Shoaib's book, which is really about reinvesting through listed markets. Because the focus was unlisted, most of these pension companies could actually satisfy the requirement based off their existing book. There wasn't actually a requirement for them to do anything. And it certainly wasn't the catalyst, as has been said, wasn't the catalyst to actually increase investment back into the UK. And I think the really interesting point was, why was listed UK equities left out of the Mansion Accord? Why were investment trust companies left out of the Mansion Accord? And of course, these are being hotly debated in the House of Lords by the likes of ex-Transparency Task Force Ros Altman, who has received bucket loads of vitriol from the industry for daring to champion the UK allocation. And then you start to understand and question, well, what is the motivation of the City Corporation and the UK asset management industry as it is majoritarily owned by US companies? Because these don't seem to want to see a shift in allocation to the UK. We have to ask why. Why would that be so detrimental to the industry to simply shift 5 or 10% of assets from the United States to the UK, or from the rest of the world to the UK? Because they still get paid.
I don't like to say this to you. The traditional exchange as we know it is dead. The future of exchanges is actually about transactions on distributed ledgers, tokenization of these things. That's 24/7 trading, and it's trading for fractions of a penny. So no more stamp duty. I mean, if III does offer tokens in the US, then it's clearly quite simple. If I want to trade III, I'll do it through tokens in the US because I have no stamp duty to pay.
Yeah. Can I also turn that around, Con, as a question back to Shoaib? Shoaib, if the London Stock Exchange didn't exist tomorrow, but there were other options for UK investors to invest in UK PLC, would the demise of the LSE matter?
Wow, what a question. Shoaib, what do you say to that?
On paper, it may not matter, but to me, the London Stock Exchange is equivalent to a national monument. It goes way back, and it will be a loss of a national asset. People have sentimental value, and I think, yes, on paper, it may not matter. And yes, I think you have to you have to be attuned to the way the investment landscape is evolving at a rapid pace. But personally, yes, to me it would matter. I would like, I think Cheryl has made this point recently, that it would be nice for people, for budding investors or people from school children, to be invited to the London Stock Exchange to see, how, how it sort of operates, and how traders used to sort of speak from the pit, and there should be some sort of photos and pictures, and it's not all about being nostalgic or anything, but I think there's this physical evidence, this element of tangibility, which is associated with London Stock Exchange, and people have emotional attachment. It's a national sort of monument. And so to me, yes, it would matter, but yes, on paper, probably not going forward, as long as people have a legitimate way of accessing British companies. Thank you.
JB, thank you. Shoaib, thank you. Shoaib, I'm going to put one question to you, and then I'm going to invite you to answer that question and share with us any final comments you'd like to make before we break the session up. The question to you, Shoaib, is this: if you're a betting man, 10 years from now, will the situation be resolved, or will the UK's investment industry be on its knees? What do you think?
Personally, I am cautiously optimistic, because when you look at the overall picture, yes, we have our challenges. So does every other country. But when you look at the legacy and how much capital we still have in the system, I think we can turn this around. And on a final note, when we look back in 10 years' time, I want this to be remembered that this was the lowest, 2025 was the lowest point in the history of the UK stock market. And that is when things sort of changed for better. And yes, I don't agree with the Chancellor on so many things, but she is making the right noises in terms of raising awareness for backing British businesses. So I can feel that vibe of Telseed from the 1980s whenever the Chancellor is speaking. Yes, I don't agree with the legislation and the way the kicking the can down the road approach in terms of the losses on gilts. I wouldn't want to go into too much details, are being and to fill that black hole. I don't agree with quite a few things, but I do agree that the government has started to listen. They have started to acknowledge that this issue is compounding and it needs to be resolved. And personally, when you look at the valuations compared to other markets, and when you look at the balance sheet strength, and when you look at the capital adequacy and overall financial robustness and health of British businesses, largely speaking, I am cautiously optimistic that we will be turning the corner going forward.
Shoaib, thank you very much indeed. Is there anything else you'd like to share with us to close the session, Shoaib?
Yeah, I think I'm all for financial literacy. I am in the process of putting together my website as well, but my main focus is for budding investors or school children, because they don't really understand what it means to own a share. If we can, yes, that it's going to take some time. It's going to take maybe 5 years, 10 years, but once we build that foundation, when the children, they understand from school age. I have sort of emailed a few schools in my local area as well. Some of them have come back to me. Some of them have simply ignored it, that I would like to come and do a little presentation to sort of raise awareness about financial literacy. I think we all need to do that. And then 10, 15 years down the road, we'll be in a very, very different situation. And we won't have to do so many things, and we won't need to worry about so many things. Just fixing the financial literacy would solve so many problems of the current stock market, in my view.
So thank you very much indeed. It's been great to hear from you.
Thank you very much.
Just before we wrap up the session, Danny put his hand up. Danny, you're going to squeak a comment in. Squeeze it in, go on.
Just a very quick one on financial literacy. All the technology, all the companies are already there. We've got Money Group, we've got UXA, we've got Wise Up Financial Education. There's stacks of them. we can't do one school at a time. It's too slow. We need the government to coordinate all the small boats. Probably not the best term at the moment, but go back a few years. We need to coordinate it, bring it together and make it happen. And we can't be waiting 5 years. It's got to happen. Okay, so that's my view on that.
Thank you, Danny. Martin White, you squeeze your hand in as well. Go for it.
Yeah, well, it was in response to Danny. I mean, I know Danny well, and I would generally agree with that. I think there is a problem, though. We can't in any way rely on the government to do this. At the moment, if you look at what's out there in terms of financial learning stuff, it's really no darn good. There's very little about real investment. There's little about conflicts of interest and issues with who to trust and expense and all that sort of thing. It's got to be a consumer-led thing, I believe.
Martin, thank you. On that note, folks, we'll wrap it up. It's got to be a consumer-led thing, so says Martin White. Can we please show our appreciation to the show? Thank you for spending your evening with us. You're still in your office, so I feel for you. You've still got to get yourself home. Thank you all. Thank you all very, very much indeed.